How can China clobber America? This question has consumed wongs since the noughties, when China began to creep up on a terror and subprime ravaged America. Military experts then thought that China would try to reconquer Taiwan, and that would force America to fight a conventional war on China's turf. Energy specialists, on the other hand, thought China would use its nuclear and its gas influence over Europe. That would then try to weaken NATO. Techies propagated China's legendary capabilities in cyberattacks and robotics to write America's obituary in what they called futuristic battlefields. But hardly anybody thought that China could use an economic weapon against America, although the portents of a wealth attack, they were hiding in plain sight. Let's go back to the beginning here. Now, tomes have been written about how Deng Xiaoping transformed China into a multi-trillion-dollar economic superpower that could rival America. Now, in my own book, Superpower, The Amazing Race Between China's Hare and India's Tortoise, I have postulated what I then called the escape velocity model. And this model is powered by two engines that were borrowed from the Soviet Union and Japan, and that enabled China to become the second largest global economy, snapping at America's heels. Using communist coercion, China began extracting massive surpluses through the 1970s to the 90s. They did that from the farmers by expropriating their land at throwaway prices. From workers by keeping wages at a subhuman level. From consumers by keeping the yuan artificially low against the US dollar. And from competing economies, especially America, by keeping the yuan artificially low against the US dollar. Note how this tactic is getting repeated. Now, this helped China-domiciled firms to export goods on a gargantuan scale to the West, and that helped them to build fantastic reserves of the American dollar. Now, this surplus extraction from farmers, from workers, consumers, this was on a scale as epic as Stalinist Russia. And they created physical assets and social infrastructure on a scale that was hitherto unknown to mankind. At one stage, China was investing nearly half, and I will say that again, almost 50% of its GDP in infrastructure. But then Deng sprung a twist in the tail. Unlike the Soviets, he borrowed a leaf from the Japanese economic revolution. He threw China open to foreign trade and investment. Now, not just that, he also learned the dirty currency lesson from the Japs, who had powered their exports by keeping the yen artificially depreciated against the US dollar through the 1970s. China therefore began wooing foreign investors with cheap land, labor, cheap infrastructure, good infrastructure, and currency to become the factory of the world. Now, as its foreign currency reserves swelled, China also became the treasury of the world. At its peak in 2011, China held nearly $1.1 trillion of American paper, and that was about 10% of the total stock. It was a happy and a virtuous cycle, because as America consumed more of Chinese exports, China lent even more dollars to America to fuel that consumption. But financial experts were getting alarmed at China's ability to inflict economic terror on America. That is, if the Chinese dumped Uncle Sam's debt, American interest rates could rise uncontrollably, and that would crush an economy that was reeling from the aftershocks of the subprime crisis. Mercifully, of course, China sued for peace, did nothing of that sort. Today, even though China's stock of US treasuries is down to about 5%, it's still a little over $1 trillion, and that's enough to keep the threat of economic terror dangling over the United States. For over 2 decades now, China has been building another cachet of $1 trillion that everybody considered was benign, and everyone thought it's a win-win. From the turn of the 21st century, Chinese companies have been in a frantic race to list in America. One of these was NetEase. It was a leading Chinese internet technology company that went public in the June of 2000. And lo and behold, It has given investors a return of 18,000% in 21 years. And that's beaten the iconic Amazon, which has merely returned 8,700%. As other Chinese IPOs rushed in, American savers picked up billions of dollars of new equity and they feasted on the dragon's astonishing growth. The frenzy peaked when Jack Ma's fabled Alibaba scooped up $25 billion in 2014. It was the biggest IPO in America, and it quickly joined an elite club of Facebook, Microsoft, Amazon, and Alphabet as the 5 most owned stocks by hedge funds. Now, despite spiraling acrimony and confrontation between America and China, nothing stopped the IPO juggernaut. Not even the shadowy ownership of several companies with invisible links to the Chinese Communist Party or the Chinese military. Not even their refusal to get mandatory audits done by the Public Company Accounting Oversight Board, the PCAOB. They took refuge behind China's secrecy laws. Now, these dodgy credentials were terribly uncomfortable, but the gravy train was unstoppable. At the beginning of this year, 248 Chinese companies worth over $2 trillion were listed in the US, with American investors holding over $1 trillion of this wealth. Now, in just the first quarter of this year of 2021, nearly $7 billion were raised, and this was an 8-fold increase over the previous year. Everything was going swimmingly. But earlier, a big crack had occurred in October 2020, which was sort of ignored by the go-go crowd. It was Alibaba again, whose subsidiary Ant Group was looking to raise $34 billion, and they were trying to beat their own 2014 record. However, perhaps in a momentary lapse, Jack Ma publicly criticized China's regulators. The Chinese government responded ferociously. It filed an antitrust case against Alibaba, forcing it to abort Ant's IPO. Jack Ma went off the radar. Alibaba's shares collapsed by 40% on New York Stock Exchange. Yet, nobody had bargained for what followed 9 months later. Didi, this was China's Uber-like ride-hailing app, had a rousing IPO in New York on the 30th of June 2021. But in less than a week, Didi was banned from Chinese app stores, citing data privacy concerns. Nearly $17 billion of American wealth was wiped out. Then food delivery platform Meituan was ordered to comply with tough labor laws, and that destroyed a third of its value. Then, in a breathtaking reversal, Chinese edtech companies were prohibited from doing commercial business overnight. Their revenue models got killed. TAL Education, TAL Education, New Oriental, and Gaotu Tech Edu, 3 of the largest US-listed Chinese edtech companies, they lost 70% of their market cap in hours. And continuing the onslaught, Tencent's exclusive rights over 80% of China's music library were rescinded. This marquee company lost $170 billion of shareholders' wealth in a few days. And this is perhaps the single largest stock wipeout ever recorded. American investors were left stunned, speechless, and of course flat-footed by such an epic destruction of wealth. China may have annihilated its edtech and consumer internet companies too. They may have done it to control domestic data and, of course, to cull overweening, overambitious entrepreneurs. But American savings became a massive collateral casualty. So China had finally clobbered America, not militarily in Taiwan or South China Sea, not via a cyber attack, not even by dumping American bonds, but by destroying the American lifeline that had nourished its tech giants. China had cut its $1 trillion nose to spite America's face. The self-flagellation was least expected. It was a typically Chinese maneuver, inscrutable.